As we know, the FCA has continued to issue millions of pounds worth of fines in recent years. But should these fines be seen as a slap on the wrist or an important opportunity for regulated bodies to learn valuable lessons which they can apply in their own organisations? Over the last few years, the FCA has continued to issue warnings and large fines against financial services organisations. But each of these investigations are largely conducted independently, and there are few holistic lessons drawn. And whilst the FCA would expect all regulated bodies to review those findings, in isolation, they do not give a view of the systemic issues they've identified and reported on. For those of you who don't know me, my name is Richard Daniels, and I've been working to prevent financial crime and fraud for the past decade or so. And so I've got a vested interest in pulling out all the valuable lessons from these FCA notifications from the last few years. So in this video, I discuss the main insights and lessons we can take from the FCA's final notices for 18 organisations spanning nearly 4 years, with a total fine of just under £400 million. So to get a view of these systemic issues, I downloaded all of the final notices related to financial crime against financial services organisations since 2020. I then utilised artificial intelligence to analyse those 18 different reports to understand specifically the systemic issues, which we'll cover in this video, but also more broadly in response to certain questions that I prompted against that wealth of information. There was a range of different financial services organisations covered in these final notices, including retail banks, investment banks, insurance brokers, payment institutions, and investment management companies. And based on the final notice that I've analysed, in total the FCA imposed fines exceeding £397 million, with the top fines being against Credit Suisse, Santander and HSBC. For context, the investigation periods covered by the final notice noted in this graph ranged from about a year all the way through to closer to 10 years for HSBC. Some of the notifications didn't actually include the investigation period, so they're not noted in this graph. So the FCA note their 5-step framework to determine the appropriate penalty for a given violation, ranging from a minor technical breach all the way to a deliberate and systemic failing, with the level of seriousness directly impacting the size of the potential fine. And this graph shows the levels of seriousness and the penalty impact from level 1 all the way through to level 5, with level 1 being 0% of relevant revenue impacted all the way through to 20%. Each of the organisations had a seriousness rating applied and put into the notification, and you can see that listed out here. Without exception, the seriousness was noted as level 3 or level 4. And if we look at our graph, that would mean that the impacted revenue or the penalty would be between 10% and 15% of relevant revenue. One thing I noted from the notifications was the steps that the FCA seemed to go through when calculating what the relevant revenue was. And I've tried to draw this out here. So we've got the revenue period would be selected, the linkage in the revenue to the particular breach associated with the breach, the revenue for particular customer groups that may have been impacted by the breach, the revenue for the business area, particularly in one case where it was funded potentially by the financial crime activity or potential financial crime activity. So if one area had a lack of appropriate controls in place, and that was funding another area of the organisation, then that could have been taken into account as well. And then there's a proportionality adjustment. And beyond the basic framework, there's several factors that can either mitigate or aggravate the final penalty imposed by the FCA. Some of the mitigants identified within the final notices included cooperation with the FCA and early reporting of any breaches, remedial actions that have already taken place and how proactive the organisation has been, whether there was identified harm to customers or customer groups. And interestingly, financial hardship was taken into account also. If the penalty and the fine was going to have a serious impact on the firm, then that was considered also. Another element that impacted the size of the fines was historic action or inaction that had taken place, but also previous fines. Pulling from the final notifications, a number of the organisations had previous fines for not applying the appropriate financial crime controls or building the right culture of compliance. We can see here, for instance, Barclays Bank had a number of fines and warnings against them historically, and the same for Commerce Bank. One mitigant that the FCA did take into account for Barclays Bank was that they agreed to make an ex gratia payment to impacted customers. And you can see the size of the ex gratia payment here compared to the fine from the FCA was clearly taken into account as part of the calculations of the penalty. So £10 million paid as ex gratia to the Premier FX customers with a fine of under £1 million. And there are a number of aggregating factors called out in the notices. Firstly, systemic weaknesses. If the organisation had shown serious deficiencies in internal controls, prior warnings was an important point called out a number of times, and I'll come on to that, where the bank or financial service organisation had been told, often on numerous occasions, to improve their control environment. Another concern was around the seriousness of the financial crime risk. If that was seen as elevated, then that would aggravate penalty also. And also if the organisation had shown that they'd ignored industry guidance or best practice. So looking at an example within the final notice for Credit Suisse, if you'd looked at the relevant revenue only, that would have been a large fine of around 6 billion. The FCA applied an adjustment, a proportionality adjustment to that, and they reduced the fine amount to 600 million. But then they took into account aggravating and mitigating actions and considerations. So the final penalty was around 150 million, taking those factors and the discount into account. And so it's quite clear the FCA do take into account the mitigating actions that the organisations carry out prior to any investigation and throughout the investigation and post the investigation. So it's really important those mitigants are understood. So why don't we look at the common failings across all the organisations where we did the analysis? The FCA called out concerns across a number of areas, the usual culprits of customer due diligence, enhanced due diligence, but also policy and procedures, transaction monitoring, risk assessments, governance and oversight, training and competence, and also financial sanctions. There is a mention of that in the final notices also. If you look at the prevalence of the concerns, in this graph you can see the number of organisations that were called out against each of those particular areas, and you can see that the largest concern raised was around anti-money laundering policies and procedures, very quickly followed by customer due diligence and enhanced due diligence. So I'm going to take each of those common failings in turn, and we'll just touch on each of them and the main points raised across all of the 18 notifications. So let's start with our favourite, customer due diligence and enhanced due diligence. The key areas called out against this area were around insufficient information being gathered, particularly around source of wealth and source of funds, inadequate verification. So even when information was gathered, the organisation often did not adequately verify its accuracy, relying on the customer's declaration without independent corroboration. And there were issues around PEPs. Now we recognise in the industry the thinking around PEPs has often evolved, but the main call-outs were around insufficient due diligence and inadequate monitoring of PEPs. And the other main concern raised was around failure to identify beneficial owners. This is particularly around corporate entities and complex structures. Moving on to the next area, which was around anti-money laundering policies and procedures. The key areas called out here were around inadequate policies, mainly around the policies having insufficient detail and not being sensitive to the specific risks that organisation faces, and also not being comprehensive enough to allow the organisation then to take those policies and standards and then evolve those into relevant operating procedures. Then there was the lack of updates and reviews. Regulation of course evolves, best practice evolves, and these were not taken into account sufficiently in the policies and procedures. And the organisation's risk profile, as that changes over time, these were not adapted and changed within the policies and procedures. And finally, ineffective implementation. There was inconsistencies of practice across the organisation, even though the policies may have been clear, and there were regulatory compliance issues because that policy adaptation into the organisation was not taken forward. Then we have another favourite, which is transaction monitoring. So some of the key shortcomings noted here were around scenario coverage, basically inadequate typology detection, and there were gaps in that coverage. Also, parameter thresholds, lots of false positives, so therefore suggesting that the thresholds weren't refined or at least understood, analysed with the appropriate testing against them, and missed suspicious activity, so almost both ends of the scale. Then there was backlogs in the alerts, so alert accumulation had occurred and there was large delays in the investigation, or at least inappropriate delays in the investigation. And also noted there was data quality issues, data incompleteness and data inaccuracies. And under the risk assessment weaknesses, the main points raised were insufficient scope. The risk assessments didn't always consider all of the relevant factors, such as customer type, product, services, geographical location, or emerging trends when it came to financial crime. As well as that, there was a lack of regular updates. The business activity changed, but that wasn't reflected. The customer base may have changed, but that wasn't reflected. Or the environment around them, the risk associated with the industry may have changed, but that wasn't taken into account in the risk assessment. And finally, they mentioned inadequate depth of risk assessments. The suggestion is that they were at a superficial level and they failed to analyse the specific risks associated with the organisation or with the customer base. Moving on to the governance and oversight failings, a number of points raised here. Firstly, lack of senior management engagement. So a real insufficiency of understanding the risk at senior management level, and poor oversight and challenge from senior managers. Also noted was unclear roles and responsibilities, undefined roles, lack of accountability. And the third area noted was inadequate management information reporting, deficient management information, and ineffective management reporting. And training and competence issues were noted. There was a lack of understanding of the training and competence required across the organisation, whether it was for customer due diligence, enhanced due diligence, transaction monitoring. There was insufficient training, inadequate policies, they were not updated regularly, and they didn't take into account the regulatory requirements that was necessary for that organisation. A lack of training and understanding, which contributed to the inconsistent application of AML procedures across different business units, and different staff members understood those procedures differently because of that lack of training or adherence to the training. And financial sanctions was mentioned against one organisation, Starling Bank. Specifically, it said that its own action plans it hadn't followed through on, and it highlighted weaknesses in the bank's systems, largely worried and concerned that they would not prevent dealings with sanctioned entities. So one of the things I was interested in these final notices was there specific financial crime that was identified. Now, the FCA didn't spot any specific financial crime, but they used terms like highly suggestive of financial crime, and they used that against a few organisations. The organisations particularly were Bastion Capital, Sapient Capital, TGM Partnership and Sunrise Brokers. It mostly related to suspicious trades, and there's a suggestion that there's ongoing investigations as to whether that was true financial crime that was implicated as part of the investigation. But general observation in the notices were around the potential for financial crime and the potential of financial crime because of systemic AML failings. Now, those systemic findings are useful, but I wanted to also find out if there was unique findings against specific organisations. And this is useful because although the common concerns are important to apply as a lens against our own organisations, these particular specific issues could be missed when considering the whole control environment. So if we take Santander as an example, the call out from the FCA was around systemic failures, largely in respect of inadequate policies, data management issues, particularly including effective monitoring of transaction monitoring, and operational bottlenecks, delays in managing the risk over time. Credit Suisse had a different set of concerns. They had insufficient weighting of risk factors when they considered their risk assessment of customers. They weren't taking into account high-risk jurisdictions as well as they needed to. They weren't taking into account military connections or intelligence information into their risk assessment. They didn't have that holistic risk assessment in place, which would then take into account things like individual risk factors and cumulative impact of risk. And they failed to act on concerns that have been raised within the organisation on potentially corrupt activities, but also on exchange transactions that were taking place. More broadly, if we're looking at the specific trends for the different types of organisations, I've just broke these into 3 areas: correspondent banking, retail banking, and investment firms. Taking correspondent banking type organisations into account, the risk is mostly around that high risk jurisdiction relationship. For retail banks, it's around the challenges of managing AML systems in high volume transaction businesses. And for investment firms, it's that vulnerability of complex trading activity. And interestingly, a number of the banks had self-identified the failings that they had prior to the investigation, or certainly throughout the investigation. Now, if we look at Gatehouse Bank as a for instance, you can see in 2013 they had an internal audit report identifying shortcomings in AML. Compliance then came in to do a review, and then 2016 internal audit did another review identifying the AML process as inadequate. So you can see that there's a trail of inactivity, or at least poor management, when it comes to building that culture of compliance and acting on identified issues either from audit or compliance. If we take a look at GT Bank, there's a ongoing trail of inactivity or shortcomings. The FCA gave a final notice in 2013. 2014, they carried out an assessment saying there's system weaknesses. 2017, there was continued inadequacies. Although GT Bank did pull together plans to resolve the issues, the actions were not executed well or abandoned prematurely. So you can see there's a trail of activity or inactivity throughout the period, which of course was taken into account with the final notice, more recent final notice and fine. Digging a little bit deeper into the good and poor practices identified in the final notices, taking transaction monitoring first this time, the poor practices were around insufficient scenario coverage, inappropriate parameters. There were data quality issues identified. There was a real lack of understanding of how the system parameters worked across the organisation. Organisations failed to act upon internal audit findings. There was also a number of good practices noted in the final notices. They were largely related to applying a risk-based approach to transaction monitoring, but also making sure that we carry out a regular review of transaction monitoring, be it the parameters, be it the risk coverage, and making sure that they're continually enhanced on an ongoing basis associated with that risk we identify. Moving on to customer due diligence, there's a number of poor and good practices identified. Firstly, on the poor practices, reliance on self-certification, we've touched on this already, insufficient information being gathered, and failure to identify beneficial owners are drawn out as poor practices within the final notices. Conversely, the good practices noted were about independent verification of the information being gathered, but also understanding the purpose and nature of the business relationship. They were called out as good practices that could be applied. And for enhanced due diligence, it was largely poor practices that were called out in the notices. Some of them are the obvious ones, like failure to conduct EDD for high-risk customers, insufficient EDD procedures. Also mentions around we should consider increasing the monitoring for high-risk relationships, and EDD should be risk sensitive, so it's not one size fits all. It depends on the customer, the relationship, etc., as to the level and the depth of EDD that should be conducted. And turn our attention to risk assessments. The poor practices noted were around having an inadequate scope for those risk assessments, but also a lack of regular updates taking place against those risk assessments. Conversely, the good practices noted were around making sure that risk assessment was comprehensive and appropriate for the organisation, and making sure that regular reviews took place and updates were made to those risk assessments. For suspicious activity reporting, the poor practices called out were around inadequate investigation of alerts. And interestingly, this misunderstanding around the rules of tipping off. And so conversely, the good practices related to making sure there's thorough investigations of suspicious activity and that there's clear guidance on tipping off. In relation to policies and procedures, the key call-outs were around inadequate policies lacking clarity, and not enough detail. Lack of guidance, again, not really drawing out the real risk associated with the organisation. The information in the policies and procedures being outdated, obsolete, not taking into account regulatory updates or best practice, and also roles across the organisation not being clear in relation to accountability and responsibility for managing economic and financial crime. In relation to governance, a number of areas were called out, both in terms of good and bad practices. Firstly, ineffective 3 lines of defence model was called out and lack of clear responsibilities, as we've touched on before. When it comes to senior management engagement, there was note of high turnover of MLROs within the reports, but also inadequate engagement on AML issues with senior management. In terms of governance, there was lack of oversight on the remedial actions that were either self-identified or as part of the investigation, and therefore in the round that was around inadequate monitoring of progress and lack of accountability. More specifically, when it came to management accountability and responsibility, there's a number of areas called out. Inaction on reports when received, so ignoring internal reports and overlooking external reports. There was also poor management information coming through to the senior management, either inaccurate data or that the information had a lack of scrutiny. Management then didn't take the appropriate proactive measures. They delayed responses in dealing with the issues, and they called out for insufficient remediation as the issues as they were identified. And there was inadequate accountability across senior management, unchallenged deficiencies because of that, understanding as who was accountable for the particular issues or concerns, but also lack of consequence when these issues were identified. The consequence management associated with them was lacking. And specifically on training and the training effectiveness, then a number of areas were called out. There was issues identified around the training scope and content. The training was too generic and it lacked specific guidance. If you look at the specific risks associated with that, there were things like large cash transactions, PEPs, high-risk jurisdictions. These were missed as key components of the training and education. The programs themselves were not specifically tailored to the roles that the individual were carrying out, ties to that generic training, but it needed to be more specific to the role being carried out. And therefore that comprehensiveness of the training wasn't there. And organizations were missing that effective assessment of how well the training was working, whether that was through testing and feedback or performance observations. And more broadly on staffing and resourcing, a couple of areas were called out. First point was around inadequate resources. One major point being just not enough staff to carry out the activity, and therefore leading to backlogs and long tail of activities, and therefore insufficient risk management. And then there is a point about whether those individuals or the organisation had sufficient technology to support the manpower doing the activity. Then there was lack of expertise, inexperienced management was called out, and limited training, which we touched on earlier. Poor practices related to ineffective oversight of the activities being carried out, and again, manual processes largely being a concern, which could have been augmented by technology. And in relation to the good practices, it was all around making sure there was adequate staffing and they were competent and able to carry out the work. When looking across all of the final notices, I was looking for areas that the FCA had recommended. They called out as specific recommendations for the organisations, and this is shown in this diagram. Firstly, they were talked about enhancing CDD, improving transaction monitoring, strengthening governance and oversight, and learning from past mistakes. Let's take each of these in turn. So on enhancing due diligence, formalize the client risk assessment, improving EDD checks, strengthen CDD documents. We've touched on those a few times as we've been through. When it comes to improving transaction monitoring, expand scenario coverage, refine parameters, address data quality issues. I'll touch on that in a later video where we touch on the key points raised around data and technology. And then enhance alert management. Not surprisingly, under strengthening governance and oversight, they talk about having clear roles and responsibilities, enhancing senior management engagement, and ensuring adequate resources. Interestingly, within a number of the final notes, it talks about learning from past mistakes, implementing root cause analysis on when issues are identified, embedding lessons learned, and actually utilizing the guidance that's out there, not just the FCA guidance, although that is specific and mentioned, also best practice and wider guidance that exists in the industry. I also wanted to draw out what the AML failings meant for organizations and perhaps for society at large. These are things that are noted in the final notifications, but more broadly as well. So things like reputational damage, eroding that customer trust, financial penalties, of course, that can impact the organization's profitability, operational restrictions. We saw that in a number of the organizations. This clearly disrupts the business operations more broadly. And then you've got increased regulatory scrutiny, and then that would increase things like costs in the organization, but also the management of that scrutiny on an ongoing basis. And then finally, management accountability. This is down to the individual fines or suspensions that could occur against an individual who aren't following through on their responsibilities and accountabilities. And then I went on to review whether there was a wider systemic concern related to AML findings and failures. And what they reports, or at least the notifications, call out is things like undermining system integrity and damaging the UK's reputation, eroding public trust, and therefore reducing investment and perhaps reduces financial inclusion, enabling criminal activity, of course, and potentially distorting market dynamics. These are what the FCA sees as broader consequences to organisations not following through and having the right compliance culture. So I think that's enough for this video. That covers a lot of the broader, more systemic concerns identified. In the next video, I get very specific on certain areas. For instance, we'll be checking within the notices around what's said around technology and data, and also against specific roles like the MLRO, the responsibility for senior management, drawing that out a little bit more detail such that we've got some real context around those particular topic areas. So how will you get advised about the upcoming video? My understanding is if you click on the like, subscribe and notification bell, then you'll be told when the next video is produced. If you've got any particular comments around this video, or indeed any comments you've noted around the final notices against each of those organisations, put them in the comments. It's good to create a bit of a discussion, specifically on areas, or particularly on areas that I may have missed in this update. And with that said, have a great day.